If you move to Canada from the US in 2025 and it's going to be your first time filing both Canadian and US tax returns this tax season, make sure you watch this video. I'm going to be giving you an overview of a few really important cross-border tax tips that you'll need to know as your first year as a Canadian tax resident. Or perhaps your first year in a while after moving back to Canada after living in the US. Hi, I'm Sonia. I'm a CPA licensed in both Canada and the US. I'm a cross-border tax consultant and co-author of my new book, Your Move to Canada. Take a look at the reviews, see what people have to say. This book is a really excellent guide as it relates to moving from the US to Canada. All right, so tip number 1. I always suggest that people work with a cross-border tax professional in the year that they move. And this isn't me being biased as someone who is a cross-border tax advisor because I don't actually file tax returns anymore for my clients. But this is as someone who's seen what's gone wrong when people don't get cross-border tax guidance in the year of their move. You are now navigating a brand new tax system with Canada, and perhaps it's the first time that you're reporting foreign income or foreign assets as a US citizen or green card holder in Canada. So there are a lot of things to consider, a lot of things that can go wrong. So I always suggest getting professional guidance, at least for the year of your move. You can avoid big penalties and overpaying taxes. One thing I've unfortunately recently noticed is a lot of people offering to prepare cross-border tax returns when they're not really qualified to do so. If the accountant who's offering to prepare your cross-border tax returns is also an expert in payroll, GST, corporate tax filings, audit, notice to readers, and they offer a plethora of different tax services, what that tells me is that they're not really a specialist in this cross-border tax space. And this is a very complex area of tax. People who I know who are cross-border tax experts really just focus on this one area. And that is what I would recommend, someone who is a cross-border tax expert, not necessarily someone who is a jack of all trades. Tip number 2 is once you become a Canadian tax resident, you have to report your worldwide income to the CRA on your Canadian tax return. So if you move to Canada and say you got a bonus payment, some RSUs, a vacation payout from your last employer that was paid to you after you became a Canadian tax resident, that is reportable on your Canadian tax return. So don't think that just because it was earned in the US or went to a US bank account, it's something that you can ignore on your Canadian tax return. Nope, you have to report your worldwide income. But that doesn't mean you're necessarily going to be double taxed on it. Ultimately, if it was earned in the US may have primary taxing rights, and you could use a foreign tax credit on your Canadian tax return in order to alleviate from double taxation. But ultimately, if your Canadian tax rate is going to be higher than the US rate, you may owe the excess to the Canadian government. And that's why determining the exact date you became a Canadian tax resident is really important. I'll link a video below that I made on this exact topic. Tip number 3, don't forget your ongoing US obligations. So if you are a US citizen or a US green card holder, you have to report your worldwide income to the IRS. So for 2025, if you move to Canada, you have to report your worldwide income for the entire calendar year to the IRS. And for Canada, you have to report your worldwide income for the period you became a Canadian tax resident onwards. You may also have state filing obligations, but very commonly, if you are moving out of the state to Canada, you may have severed your US state residency, so you may have a part-year state tax filing obligation, where you only have to report your worldwide income to the state for the period that you lived there, but not for the period after you moved out of the state, unless you have some sort of trailing income such as a bonus or equity compensation that was paid to you after you moved out of the state, but was technically earned while you were living in that state. See how it can get complicated? This is why a cross-border tax advisor is generally a good idea, at a minimum for the year of your move. All right, tip number 4 is tax deadlines. So in Canada, we have an April 30th tax deadline, but if you or your spouse is self-employed, you have a June 15th filing deadline. Now, that is a deadline to file, but your deadline to pay is April 30th, regardless of whether you are self-employed or not. Now, the US has extensions, but Canada doesn't have extensions. April 30th is the deadline for most individuals. Now, in the US, your tax filing deadline is April 15th, but you could file for a 6-month extension using Form 4868. So a lot of people ask, which tax return should I prepare first, the US or Canada? Well, the way that I see this question is you should be kind of preparing them at the same time, because technically you have to report your worldwide income to both Canada and the US. But once you have both those tax returns drafted, you do have to claim foreign tax credits based on the tax liability of the other country. There can even be situations where you have cross foreign tax credit claims, where you have US sourced income on your Canadian tax return that you have to claim a foreign tax credit from the US filings, and vice versa. You have Canadian income to report on your US tax return, which will require foreign earned income exclusion or a foreign tax credit claim based on the Canadian filings. So they kind of have to be prepared at the same time. Tip number 5 is foreign asset disclosure. So if you are a US citizen or green card holder, this is probably something that you're going to have to deal with for the rest of your life if you're not already dealing with it. So something that is very crucial is the FBAR. The FBAR is a foreign asset disclosure form that is required if cumulatively with all of your foreign assets at any point in the year, they exceeded the equivalent of $10,000 US. It's a disclosure form that goes to the Department of Treasury. It's technically a separate filing from your US tax return, but generally it's all kind of prepared at the same time. So if you have foreign assets such as a Canadian bank account, Canadian retirement account, like an RRSP, brokerage account in Canada, really any financial assets have to be disclosed if you meet the threshold. Also, there's another foreign asset disclosure form that goes to the IRS that's part of your US filings, and that's Form 8938. That is required if you are a US person and you have foreign assets. Generally speaking, you report the same information on the 8938 that you report on the FBAR, but they just go to different places. The threshold for having to file Form 8938 is higher than the FBAR, and it's dependent on your filing status, whether you're single, married filing separate, married filing jointly. So I'll leave a link below to the IRS website, which goes over the thresholds that indicates whether you have to file this form. And again, for all these foreign asset disclosure forms, they don't result in any extra taxes, but they result in very substantial penalties if they're late or missed. So it's not like you're being taxed extra for having foreign income necessarily, but you just have to report your foreign assets. Now in Canada, we have our own form of foreign asset disclosure, which is called the T1135. T1135 is required if your non-Canadian assets exceeds the equivalent of $100,000 at any point in the year, and that's Canadian dollars. The T1135 in Canada is technically for specified foreign property, which can include both financial and non-financial foreign assets. But there's a lot of exclusions for specified foreign property. For example, your 401k and your traditional IRA and your Roth IRA, as long as you file the valid election, which I will go over. And also personal use US property. So for example, your US home that isn't an investment or a rental property, that is also excluded from the T1135. But say you have US stocks, a US brokerage account, a US bank account, those kind of assets are considered for the T1135. And again, it has to be filed if the cumulative value at any point in your year of residency exceeds 100,000 Canadian dollars. Now, you get a first year exemption from the T1135 if it's your first year ever being a Canadian tax resident. So if you're returning to Canada after living in the US for a number of years, this exception won't apply, but if it's your first time ever in 2025 living in Canada, then you don't have to file the T1135 for 2025, but you will for 2026 onwards, if you meet the threshold. All right, the next tip is the Roth IRA. The Roth IRA can be a completely tax-free account in Canada as long as you file a valid election. Now, I'll leave a link below to the CRA guidance on Roth IRAs in Canada, which gives you the information you need to know to file that election. And again, if you're working with a cross-border tax accountant, they should file this election for you. If you have a Roth 401k or a Roth IRA, it can be tax-free as long as you don't make any Canadian contributions. A Canadian contribution is a Roth conversion or a Roth contribution during your Canadian tax residency. If you have done this as a Canadian resident, unfortunately, your Roth IRA is tainted and it's not going to be tax-free in Canada. That really signifies the importance of getting proper cross-border tax advice. I've seen people who've had significant Roth IRAs move to Canada and they made a contribution. Fortunately, they lost out on the ability of that Roth IRA being a tax-free account. So the election is very simple. There's no prescribed form. You essentially just have a statement summarizing your Roth IRA, such as the account number, the value of the account at the time you became a Canadian tax resident, and just a statement that going forward you will not be contributing to your Roth IRA, and that preserves its tax-free status in Canada. All right, tip number 7, joint filing. US has joint filing. US, if you are a married couple, you could file one single tax return as one economic unit, but Canada does not have this. So in Canada, spouses have 2 separate tax returns. A lot of people have some confusion. They say, no, I do file tax returns jointly with my spouse. Well, you can prepare your tax returns at the same time. Generally, when you have tax softwares, you could prepare them in tandem, but they're really technically 2 separate tax returns. One spouse reports all their income, the other spouse reports all of their income. There are some abilities to income split in certain situations. They are separate filings, so keep that in mind. Next is your US accounts. Your traditional IRA, your 401k, your Roth IRA, provided you file the applicable election, is not a taxable account in Canada. You do not have to pay taxes on earnings within the account. You only have to pay taxes on withdrawals from your traditional IRA and 401k. And as I mentioned, these accounts are also excluded from specified foreign property for the purposes of disclosure on the T1135. So if you make a withdrawal from your pre-tax US retirement account, you have to convert that to Canadian dollars, report it on your Canadian tax return. There are foreign tax credits available to alleviate from double taxation. Now, how about your US brokerage account? Your US brokerage account, just like it was a taxable account in the US, is a taxable account in Canada. In Canada, you get something called a step up in your cost basis, which means that the cost basis of your assets in that brokerage account for Canadian purposes is the fair market value of those assets on the day you became a Canadian tax resident. So for things like publicly traded securities, it's very simple to look up what that was. But for things like mutual funds, you may have to go to the broker and request that information. So if you sell those assets as a Canadian tax resident, your Canadian capital gain is only going to be based on the growth of the value during your Canadian tax residency. Any pre-residency gains are not going to be taxable. But again, worldwide income. So if you're a Canadian tax resident, you have to report all transactions, dividends, interest, capital transactions. Also keep in mind that certain income that is tax-free in the US is not tax-free in Canada. For example, municipal bond interest in your US brokerage may be tax-free in the US, but it's not tax-free in Canada. In fact, interest income is actually one of the least tax-efficient income sources in Canada. Capital gains get a much more preferential treatment, as well as Canadian dividends. US dividends also do not get very good treatment for Canadian tax purposes. Everything is taxed at your highest marginal rate. And the last tip I'll go over is selling your US home. So a lot of people panic. They say, oh my gosh, I need to make sure that I sell my US home before I move to Canada. I don't want to pay Canadian capital gains tax. But remember how I went over the step up in cost basis. Your capital gains in Canada are only the difference between what you sell the asset for and what it was worth when you came to Canada. And this also applies to your US real estate. So if you sell your US real estate shortly after moving to Canada, you might not actually have a Canadian capital gain, because it may not have appreciated in value during your Canadian residency period. I made a whole entire video about your US property and how it is impacted after moving to Canada. I'll make sure I link that below. All right, I hope this was a helpful video for everyone. If anything, hopefully it made you understand that these things can definitely get complex. There's a lot of things to consider. I always suggest getting some professional guidance as it relates to moving from the US to Canada. Unfortunately, I don't prepare US tax returns. I do currently work as a tax consultant in cross-border wealth management. If you have any questions for me, if you want to reach out, you can email me. I'll leave the address in the description below. And again, all of the things that I covered are in my book, Your Move to Canada. Make sure you check it out on Amazon. All right, have a good day, everyone. Bye-bye.